Hello everyone and welcome back to these sessions on Advanced Strategic Financial Management. In continuation of the topic Advanced Capital Budgeting, let us discuss Monte Carlo Simulation Analysis. Now this is yet another way to use the probability distribution information to arrive at the expected results based on simulation. Let us first focus on the meaning of the term simulation. What do we mean by simulation? It's basically creating a scenario, imagining a scenario as if it is happening in reality. So the word simulate or simulator or simulation, it comes from that imaginary thing. So for example, you have made a kind of structure which resembles Taj Mahal. Now this may not be the actual Taj Mahal, but it could be considered as a model, or you can call it as a simulated structure which is resembling the main structure. What is the role of simulation in risk analysis under capital budgeting that you need to understand? Here we are going to use the probability distribution and we will simulate the results. We will try to draw expected results out of the random number information that we have. Now this whole theory has so much connectivity with the study of random numbers. Now what are random numbers? Random numbers are basically series of numbers which are generated by a computer, because humans may not be in a position to generate random numbers. For example, if I ask you that you give me 1000 two-digit random numbers, and when I say two-digit random numbers, it will start from 00, 01, 02, 03, 04 and go on until it reaches the highest two-digit number, which will be 99. So from 00 to 99, there will be 100 two-digit numbers, correct? If I ask you to create a series of 1000 such numbers and rapidly start giving me those numbers, so you start giving me two-digit numbers like 32, 56, 69, 92, 07, something like that. When you keep mentioning that 1000 times, if you have truly generated these as random numbers, there are in total 100 numbers from 00 to 99, and I have asked you to mention 1000 numbers. So logically each number should have frequency of 10 times, because if the numbers are truly random, the probability of occurrence of these will be equal. But you try doing that, you will not be able to achieve that randomness, and that is why random numbers are generated from a computer system. Now what is to be done? You have to first identify that what exactly is the key variable, or if in case of multiple variables, what are the key variables for which the simulation results have to be drawn. For example, if I ask you to compute NPV of a project, what all variables you require? You require the initial investment. Most cases the initial investment has to be made immediately at the start of the project. The uncertainty associated to the initial investment is either not there or is negligible. So there is no uncertainty majorly associated with the initial investment. So we don't have risk pertaining to that to a large extent, but other variables like life of the project, annual cash inflows, or what you can call as CFAT, cash flows after tax, the cash inflows after tax. Then the discounting rate. All these variables may undergo a change over a period of time, and that is what brings risk. Now you might be wondering, sir, all these aspects we have discussed. Yes, of course we have discussed. If you can recall, when we have learned scenario analysis or when we have learned sensitivity analysis, that time we have discussed that these are the variables and the variables may undergo a change. If these variables change, the NPV will be affected, sometimes favorably, sometimes adversely. And that is where the risk is involved in your capital budgeting decisions. Now, how to apply Monte Carlo simulation technique for analyzing the risk. So the idea is to imagine that, okay, first year this will happen, second year this will happen, and this is not a vague imagination. This imagination is basically what we call as simulation. You are simulating what would be the outcome of this project. Now, when you are simulating, you are parallelly using two information. Number one, the probability distribution with respect to each variable informed in the question, and through those probability distributions you have identified the range of random numbers, and you start fitting the random number at the required range, and based on that you draw the simulation results. So what I am talking will be understood actually when I am giving you examples, and here you have to patiently listen to me. So chances of a question coming from simulation analysis in exam is extremely rare, but we cannot afford to leave it. That is why I am discussing this whole thing. Let us assume that the future cash inflows, they have been given along with a probability distribution. That means uncertainty is associated with future cash inflows. I give you a range of cash inflows like 30 lakhs, 32 lakhs, 34 lakhs, 36 lakhs, 38 lakhs, 40 lakhs. 6 different cash flow estimates I have given to you along with their respective probabilities. 30, 32, 34, 36, 38, 40 in terms of lakhs of rupees along with their probabilities. The first thing that you do is cumulate the probabilities. For example, the first probability that I have informed you is 0.09. Then the next one what I have informed you is 0.15. So you start taking 0.09 plus 0.15, that will give you 0.24 and so on. By the time you go to the last line, the cumulative probability will actually sum up to 1. Of course, it has to be, because the probability distribution, the overall probability of all events taken together will always be 1. So cumulative probability will go to 1. Now, Monte Carlo simulation analysis, it follows the series of 2-digit random number. You keep in mind one thing, that even 00 is a number. So you will not write a single 0 as per the simulation analysis suggested by Monte Carlo. If it is a 2-digit random number, its value is 0, then you have to mention it as 00. So 00, 01, 02, 03, 04, like that you keep on counting till you reach the highest 2-digit number, that is 99. There will be 100 such 2-digit numbers. So what you do is you set a range, correct? You set a range starting from 00 to the required number. Now you have to be smart enough over here. The range should include the number of random numbers based on the probability and cumulative probability. And how to do this, I'll explain this through an example which will be better for you. Once I take that example for you, you will get a complete idea of how to identify these random numbers through the given range and using the probability information with respect to each variable. So there can be a single variable, there can be multiple variables. Now with respect to random numbers and selection of random numbers, there can be two possibilities. Number one, question itself gives you the exact random numbers that you should consider for your simulation runs. If that is the case, then each and every student sitting and writing exam across the country will be picking the same random number and hence picking the exact same values. Then and then only there will be uniformity in the answers. However, Monte Carlo simulation analysis doesn't start with a given set of random numbers. From a big random number table generated by a computer system, you start picking the two-digit random numbers. You start picking the two-digit random numbers, and how to pick random numbers, that is also a small exercise that we will be learning at a little later stage today. So what we do is we get started with some steps writing in Monte Carlo simulation analysis, followed by series of a couple of questions for understanding how to apply this concept. So what I want you all to do is please write this heading in your notebooks, that is Monte Carlo simulation analysis, as the subtopic within advanced capital budgeting. And once you have written this heading, Monte Carlo simulation analysis, let us start writing some steps with respect to how to obtain simulation results. So steps for obtaining simulation results. Identify the different variables for which probability distribution has been informed. These variables are to be considered for the simulation runs. Determine the cumulative probabilities for each variable based on the available probability distribution. Formulate the range of two-digit random numbers with respect to various possible outcomes as per the cumulative probabilities. The range for such two-digit random numbers should begin from 00 and it should go up to 99. First write these initial three steps and then I take you ahead. Alright friends, once you have completed writing these initial three steps, let us move ahead and continue writing further. The fourth step, obtain the simulation results based on the random numbers informed in the question with respect to each variable. If the question does not inform the random numbers to be considered, then follow the procedure for identifying the random numbers from a given random number table. Now how to do this, I'll explain you at a little later stage, but chances of you identifying random numbers on your own is extremely low, because the obvious reason I mentioned is, in that case every student will have a different answer and examiners may not want that. For them to have a standardized solution, they only will have to mention the random numbers in the question. Anyway, you write this step, I'll explain you both ways, when random numbers are informed in the question, when random numbers are not informed. Alright friends, so once you have completed writing this step as well, let us move ahead. Let us take up question number 30. Let us read this question. NJ Limited is planning a project that is expected to have a life of 10 years. The estimates of future cash inflows from this project is highly uncertain. The company is to consider simulation technique for estimation of future cash inflows over the life of 10 years. The probability distribution with respect to the cash inflows are as follows. The annual cash flows amounts and their respective probabilities have been given to you. Then the question says two-digit random numbers for the simulation are as follows. So what we expect mostly in examination, these random numbers will be given to you along with the question itself. Using the Monte Carlo simulation technique, make an estimate of cash inflows over the life of 10 years. So fine, how do we proceed with the solution? So there is only one variable along with probability distribution given, and that is annual cash flow. So this annual cash inflow could be 5 lakh, 6 lakh, 7 lakh, 8 lakh or 9 lakh with these respective probabilities. You can add up all the probabilities and check that the aggregate must be 1. So first thing that you will do is you will identify the random number range by taking cumulative probabilities out of this. So here what I want you all to do is first you get actively involved with respect to what is the information given over here and try understanding how are we going to approach the solution. You know what you need to do. As I said, you first take cumulative probabilities. So just pick your calculator and take 0.12, to that you add 0.23, the cumulative values will go to what? 0.35. Then to that you add 0.34, it will become what? 0.69. Then add 0.22, it would become what? 0.91, and then 0.09 further added, it will be 1.00. So 5 lines for the 5 cash flow estimates. Okay. Now you have to select a random number range which will start from 00. Now because the probability is 0.12, out of 1 as the total probability, the probability is 0.12, means 12 out of 100 outcomes, correct? That means 12 random numbers have to be allocated to that first cash flow information starting from 00. So if you count from 00, 00, 01, 02, 03, you have to compute and count. You have to consider in total 12 random numbers. So when you started from 00, the 12th random number in that series will be 11, correct? From 00 to 11, that will be the random number range for the first line. Then in the second line, the cumulative probability is 35. So you have to count up to 35 random numbers. The 35th random number will not be 35. The 35th random number will be 34 because your count started from 00. Don't forget that. Your count started from 00. So from 00 to 11, 00 to 11 was the random number range in the first line. The second line, random number range begins from 12 and it goes to what? It begins from 12 and it goes to 34. So if you count 12, 13, 14, 15, 16 up to 34, there will be in total 23 random numbers of 2 digits that you will get from 12 to 34. That is signifying the probabilities over here. So use your simple common sense. Higher the probability, the bigger will be the range of that particular random number distribution. And therefore, when you are given these 2-digit random numbers in the question itself, then you will pick a particular random number for that simulation run and you identify to which range it belongs, and accordingly what will be the simulated cash flow for that you have to identify. So when I am explaining this to you while I carry out the solution to this question, I want you to minutely pay attention to all these details. So let me show you the calculation of cumulative probabilities and setting the random number range. So you please write the heading in your solution: determining cumulative probabilities for the annual cash flows and setting the random number range. So in a small table, you just make up these 4 columns. You identify your annual cash flows and plot the given probabilities in the question along with that. Now, as a follow-up, what you do is you take cumulative probability. So, in the first line for 0.12, the cumulative probability will remain same, 0.12. Then 0.23 added to 0.12, the cumulative probability becomes 0.35. Then 0.34 added to 0.35, the cumulative probability goes to 0.69. Then 0.22 added to 0.69, you will be getting 0.91 as cumulative probability, and then 0.09 added to 0.91, what you get is 1.00. Now, what we need to do is we need to identify a range of random numbers, and the random numbers of 2 digit begins with 00 as the starting point and it goes up to 99. So there will be 100 random numbers from 00 to 99, which are 2 digit random numbers. So we even consider 00 as a number. So the count goes this way: 00, 01, 02, 03, etc. So we need to first fit the probabilities of initial 12 counts, which will start from 00. So if you count 12 random numbers starting with 00, it will be 00, 01, 02, 03, like that. If you go on up to 11, from 00 to 11, it will be 12 counts. Thereafter, because the cumulative probability is 0.35, the next range of random numbers will start with 12 and will go up to 34. So 12 to 34 will be the random number range. Now you look at one thing, 12 to 34, if you count the number of 2 digit random numbers that we have taken, it is basically from 34 you subtract 11, it is 23 random numbers which are ranging from 12 to 34. So if you count the number of random numbers over here, that is the number of 2 digit random numbers like 12, 13, 14, 15, 16 and so on, there will be 23 such numbers ranging from 12 to 34. Then the cumulative probability is 0.69. So you know what is the real trick? You look at the cumulative probability, it is 0.12. So the number begins from 00. So 00 is also a number, and what you need to do is, if it is 12 count, you take 00 to 11. That will be 12 count. Obviously the next range has to begin from 12. Immediately after 11 what comes is 12, and we end it at 34 because the cumulative probability has ranged up to 0.35. Similarly, if the cumulative probability over here has ranged up to 0.69, the random number range will be starting from 35, because after 34 the next number will be 35, and it would go up to 1 less than 69, that will be 68. So 35 to 68 is the third range. Then the next range will begin from 69, and here it is 0.91, so it will go up to 90. So 69 to 90 is the random number range for the fourth component of cash flow, and for the last one it will begin from 91 and will go up to 99. The most important thing is to fit the correct random number ranges, and this is what you have to practice out very clearly so that there is never any confusion. I am giving you time, quickly take note of this entire table and then we move ahead. Alright friends, once you have completed writing this table, what we need to do as the next follow-up step, we go for simulating the annual cash flows over the next 10 years as per the random numbers given in the question. So you plot a table, and for each of the 10 years, the given random numbers in the question, you just copy these random numbers, and then you have to look into which is the random number range within which this random number will get fit. So based on the random number ranges that we have identified, 12 will come in the range which we have fixed as 12 to 34, and the corresponding annual cash flow for that will be rupees 6 lakhs. Likewise, 71 will come in the range of 69 to 90, and the corresponding cash flow over there is 8 lakhs. 27 will come in the range of 12 to 34 again, and the corresponding cash flow is 6 lakhs. 92 will come between 91 and 99, for which the corresponding cash flow is 9 lakh. 45 will come in the range of 35 to 68, for which the annual cash flow is 7 lakhs. 39 will come in the same category. 58 will also come in the same category. So the cash flows will be 7 lakh, 7 lakh, 7 lakh. Then 74 will come into the next range, that comes from 69 to 90, for which the corresponding cash flow is 8 lakhs. Thereafter, the next random number 10 will come in the range 00 to 11, for which the cash flow is 5 lakhs. And the last random number is 43, which will again come between 35 to 68, for which the corresponding cash flow is 7 lakhs. So please write up this entire table and then I take you ahead. Alright friends, once you have completed writing this entire table, it will be end of this solution, because in this particular question there was nothing beyond this whole thing. So now let us do one thing. Let us move ahead and learn how would you identify random numbers for the purpose of simulation. What is appearing in front of you is a random number, a series generated randomly, and here if you are given an instruction that identify 10 random numbers of 2 digits, picking the last 2 digits starting from the first row, third column. So first thing you need to identify that from this big table, you have to identify 10 random numbers of 2 digits. And what you have to do is you have to pick the last 2 digits. And what will be your starting point? Starting from first row, third column. Now, let me first go to first row, third column. This is first row, this is third column. So first row, third column number is this. Now from here, we may go horizontally forward or we may go vertically. When there is no instruction, you can go either way you want. There is no hard and fast rule. But I would prefer going vertically. So we are picking the first row, third column, and we are picking the last 2 digits. So identify what are the last 2 digits in this number. What I get is 36, correct? So I have identified 36. So in the same manner, keep on picking the numbers as the last 2 digits of these series of numbers. So what we will get after 36 is the next row 16, then the next row 23, then the next row 72, then the next row 53, 88, 63, 69, 23 and 37. So the answer for this particular random number selection would be mentioned as 36, 16, 23, 72, 53, 88, 63, 69, 23, 37. This is how a series of random number is picked up. So there is nothing for you to write over here. It is just for your understanding. Let us take one more example for better understanding. Same table, and now I am asking you to identify 10 random numbers of 2 digits, picking the first 2 digits starting from first row, first column. So now you start from first row, first column, and you have to pick the first 2 digits. It can be the first 2 digits, last 2 digits, anything. Now first 2 digits over here will be 53, followed by the next row, that is 97, then 66 and so on. So 53, 97, 66, 99, 30, 81, 19, 9, 31 and 67, and we will write up the same random numbers over here: 53, 97, 66, 99, 30, 81, 19, 9, 31 and 67. These are the couple of examples that I have explained for you to identify how to pick random numbers. Now let me tell you, in examination, the possibility of you selecting random numbers on your own is negligible, because in that case any student will pick the random number selection from anywhere in any order, and that is where everyone's answer will differ. That is why in the earlier question we have seen that the question itself gives you the required random numbers for calculating or for deriving the entire simulation run. So let us take up one of the examples given in your institute study material, which in my book it is given as question number 31. It says NJ Limited is planning a project that has initial investment of rupees 1,30,000. The estimates of future cash inflows from this project and the project life are highly uncertain. Now look at one thing. Previous question we have seen only the annual cash flow were the uncertain elements, right? Here there are two different patterns of uncertainty coming forward. One is the annual cash flow, which is given along with probability distribution. Another is the project life. That is what mentioned over here. The estimates of future cash inflows from this project and the project life are highly uncertain. Cost of capital is 10%. The company is to consider simulation technique for estimation of future cash inflows and project life for 10 simulation runs. The probability distribution with respect to these variables are as follows. So for these two variables they have given you the probability distribution. Moving forward, what we get is the question further asking you to consider the following random numbers. Now they have given a big table. 10 simulation runs are to be performed for the project. To perform this operation, values are generated at random for the two exogenous variables, that is annual cash flow and project life. For the first simulation run, take the 2-digit random numbers, picking the first 2 digits starting from the first row, first column. That is 53 for annual cash flows and 97 for project life. Now this is something important. When the question has given you a table and the examiner wants you to have a specific random number selection, look at the instruction given over here along with an illustrative example. They want you to consider first row, first column. So this is the first row, first column, and you have to pick the first 2 digits. So of course it is 53. If you go vertically, it is 53, 97, 66, 99, you know how it goes. But for the first simulation run, they have asked you to pick 53 and 97. So that means 53 as this number and then 97. So 53 and 97 are picked for the first simulation run. 53 will apply to the first variable, that is the annual cash inflow, and 97 will apply to the next variable, which is the project life. So considering that, we will come up with two different set of random number ranges. One will be pertaining to the annual cash inflows, another with respect to the life of the project. So in your solution, let me show you what you need to do. You get started in your solution with determining cumulative probabilities for annual cash flows and setting the random number range. So for annual cash flows, first you copy the amounts of annual cash flows given in the question along with their respective probabilities. Then what you do is you take the cumulative probabilities. You know how to take cumulative probabilities. And now how would you set the range of random numbers? Look at the probability value. It is 0.02. So if I take 2-digit random number range and the value over here is 02, I will have to take one lower value because I need to fit two numbers only over here. So I will take 00 to 01. The second range will begin from 02, and because over here it is 05, it ends at 04. So 02 to 04 will be the second random number range. The third range will begin from one number greater than 04, that will be 05, and because it is 0.20 given over here as cumulative probability, the range will end at 19. So it will be 05 to 19, then it will be 20 to 34, then 35 to 64, then 65 to 84, and then 85 to 99. please don't just copy these figures, understand and note it down. Alright friends, I'm sure you have understood how to identify the cumulative probabilities and 2-digit random numbers, that is the range of random numbers. Now let me take you ahead and we identify the cumulative probabilities for the years and setting the random number range, that is the second variable. So project life is the second variable. The value over here will be in terms of number of years, 3, 4, 5, 6, 7, 8, 9 and 10. These are the respective values given in terms of number of years, and the corresponding probabilities given in the question have been plotted. I'll give you maybe a couple of minutes to identify on your own what will be the cumulative probabilities and 2-digit random numbers over here. So find the range of random numbers. I am giving you a couple of minutes. Your time starts now. Alright friends, I have given you enough time to identify what would come over here. So the cumulative probabilities 0.05, 0.15, 0.45, 0.70, 0.85, 0.95, 0.98 and 1.00. Based on the cumulative probabilities, the 2-digit random number range that you should have identified will be 0 to 04, 05 to 14, 15 to 44, 45 to 69, 70 to 84, 85 to 94, 95 to 97 and 98 to 99. These will be the random number ranges. So please check your answers and then I take you ahead. Alright friends, once you have checked your identification of this random number range along with the cumulative probabilities, we now step into the most critical part of the solution, where you have to refer to the random number table given in the question. As per the question's instruction, you have to pick the first 2 digits starting from first row, first column and moving vertically forward. And what you need to do is, the first 2 digits, you have to not pick one number for one run. Actually, you have to pick a set of 2 numbers for one run. So for the first run, it will be 53 and 97 that you will have to identify, and that will be for the first run. 53 for the annual cash flow and 97 for the project life. Likewise, for the next run, it will be combination of 66 and 99, 66 for the annual cash flow, 99 for the project life. Then for the third run, it will be combination of 30 and 81. Then for the fourth run, it will be 19 and 9. Fifth run, it will be 31 and 67. In 5 runs, if this whole thing got exhausted, what you need to do is you now pick from the second column and again keep picking the first 2 digits and keep going vertically downward, and you will be getting the random numbers for the next 5 runs as well. So I am sure you understood how to pick the random numbers from the table. Now moving forward, what we do is we plot the simulation results, and what I will do is I will go for the first run where the random numbers will be 53 and 97, 53 for annual cash flow and 97 for project life. The corresponding value of annual cash flow for this random number based on the random number range that you have plot, it will be rupees 30,000, and based on 97 as random number for project life, the project life corresponding value for that random number range that you have identified will be 9 years. Similarly, for the second run, the random numbers are 66 and 99, and the corresponding value of annual cash flow will come to 35,000 and 10 years for project life. You have to go on like this for the next 8 runs. Now, I am not going to show you the calculations over here. I will give you a couple of minutes. You plot the required values in this table. Your time starts now. Alright friends, I am sure within this given time you would have identified all these calculations correctly. Look at your calculations and check and see if it is matching. In case it doesn't match, make the required correction and look into whether you have identified all these correctly or not. That correct identification is important because your NPV calculation will be based on these variables that you are identifying through simulation runs. So take a moment, take a minute's time and check all your calculation, and then I take you ahead. Alright friends, once you have identified that all your variables, that is annual cash flows and project life for each of the 10 runs are identified correctly, we now move ahead and compute NPV for each of the 10 runs. Now this is going to be a very simple task. You know, the annual cash flow for the first run was 30,000. Based on the life that we have identified in the first run, that is 9 years, and the discounting rate given in the question as 10%. So you identify the annuity factor at 10% for 9 years. Whatever you get, you multiply that to the annual cash inflow, and from that you subtract the initial investment in the project to obtain the NPV. Similarly, when you come to the second run, it will be 35,000 as your annual cash flow. Project life will be 10 years, and accordingly the annuity factor comes to 6.145, and then subtract the initial investment and you get the project NPV. I'll give you another 3 minutes to identify all the other calculations for the next 8 runs. Make sure that all your NPV calculations go correct. Your time starts now. Alright friends, I have given you enough time to make these calculations. You just need to check all your calculations now, whether everything is correctly identified and calculated. 2 things you are simulating: the annual cash flow and the project life. One thing what is constantly given to you is the initial investment in the project and the discounting rate applicable for the company. Please check all your calculations, and once you are clear and fine with this, we will move ahead.